Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, December 7th, 4:51 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, bear market rally fading badly. Consolidation day today still holding above key 3,900 support, but multiple closes under the 21-day exponential moving average for 4 of the 5 indexes. So that's downgraded from bullish to neutral on short term. Medium term, all 5 of the major indexes still above the 50-day moving average. Long term, mixed bag versus the 200-day moving average. S&P 500 most recently failing there badly. NASDAQ 100 never got above it. Small caps failed there. We still have the Dow firmly above it and mid caps hanging on by a thread. So what happened today? About a 0.25% gap down at the open. Very volatile opening 2 hours, up, down, up, down. But really, we stayed within a pretty tight range all day, less than 1%, and held the bottom of the range, but failed several times trying to get back above the 21-day moving average on the S&P. That coincides to that 3950, 3960-ish, formerly support, now resistance area. So here's the final numbers. G6 down 0.16%, S&P down 0.2, NASDAQ 100 down 0.4, Dow just slightly positive, mid caps down 0.2, Russell down 0.3. Global diversified 60/40 up 0.14%. Most of this bonds, as the global part, the global stock part that we use, for the 60 is down. GROTECTION slightly positive on the day. Some decent performance by some of our stocks. We took a profit in one of them and trimmed our index long as it failed into that 21-day average. Still have the hedges in place, so about 90% of that is hedged. We'll go over everything that we still own when we go through the focus list. Let's get into what we do here at Revere. Let's go back to the good old days for a change, huh? Let's go back 2 years. Let's go back to 12/7/2020. And what a lovely time this was for growth investors. We had the very serious COVID panic, down 34% in 5 weeks. We bottomed. We got above the 21-day moving average at the beginning of April and trended nicely above it all the way until August. Had a little bit of a pullback consolidation here, and then we broke out into the end of the year, trending above the 200-day, the 50-day. The 200-day is the black line, the 50-day is the red line, the green line is the 21. When we're trending above there, we are as heavy into the market as we can possibly and comfortably be. When the averages start to roll over and break below the 50, break below the 21, and the slopes of the lines roll over, we'll take some off. But as long as we stay above this black line, that's the key line, that's the 200-day moving average. As long as we stay above there, we'll stay engaged in the market. But now let's reset it back to today and the ugly market that we faced starting in January, but really kicking in April with these 3 legs down that we had. Once we get below the 200-day, we get extremely defensive. And of course, the reason for that is this chart right here. Every bear market going back to 1968 occurs under the 200-day moving average. This is when your capital is at risk. This is when we really ratchet up the defense mechanisms and just look for short-term entries and see where the market goes, and hopefully it can rally and get back above the 200-day moving average, very similar to how it did back in COVID. Let's go back to 2020 again and take a look at the transition here. We started rallying in April. We got back above the 200-day moving average in May, back tested it twice in June, but held. As long as we hold there, we're in good shape. But now, just the opposite. We can't get back above it. So we spent 3 days above it after Powell euphoria last Wednesday. That's in the rearview mirror now. 5 straight days down arguably 3 of them consolidation days. But still, we're below that 39.51 pivot, which is where we were when Powell started speaking on Wednesday, or I should say when his speech was released, and then the follow-up Q&A launched a big rally, and the market was liking his dovishness, but since then some strong economic data has come in. The employment report on Friday, some additional data early this week, and the market has given back all of those gains. And we've rolled over on the stochastic on all the indexes, also on all the growth indexes, and also on the NASI McClellan summation index. So they switch from tailwinds to headwinds, and right now, as long as we hold above 3,900, we're holding on, and we're not going to get completely out because our stops haven't been triggered. And however, the index portion, with us being below the 21 and it's starting to roll over, that's, as I said, fully hedged. So we'll see who wins, and we may need to wait until next Tuesday and Wednesday, when we've got CPI on Tuesday and then the FOMC decision on Wednesday. We'll have to see how the market reacts to that. Probably days similar to today leading into that. I'm not going to make any predictions. I'm basically neutral right now, as long as we stay above 3,900 but below the 21-day exponential moving average. So that's the S&P 500. Let's move on to the NASDAQ 100. Continued weakness, 2 closes below the 21. The 21's rolled over, 5 down, coming up to the 50-day moving average. Contrast that with the strongest of the big cap indexes, the Dow. 2 closes right on the 21. Stochastic has rolled over. We mixed in, we finished positive, barely positive on the day, up less than a point. But 2 of the last 5 days have been positive on the Dow, and that really is a reflection of growth money rotating into value. And of course, you got the big blue chips in the Dow. That's where the money rotates when it gets scared. Let's look at mid caps. Still 2 closes below the 21 now. Slope of the line rolling over, but holding this 200-day moving average right at the 450 level. Can't say the same for small caps IWM. 2 closes below the 21, but now 3 closes below the 200, coming up to the 50-day moving average, which is trending higher. A couple of other key indexes. Let's look at the equal weight S&P, holding on to the 200-day moving average and the 21. For that matter. So again, that just further reinforces these big FANG type stocks at the top of the indexes are what is dragging the S&P 500 and the NASDAQ 100 lower. Let's go to the equal weight NASDAQ. Certainly in better shape, hanging right on the 21, but below the 200. But notice it did get it back above the 200, while the NASDAQ 100 was unable to. Some additional, let's go to the VIX. The VIX actually ticked above the downtrending, and now it's flattening out the 21-day exponential moving average today. So that's a minor change in character. It is just 1 close above, and it's less than 0.3% above it there. And we are still below that 24 to 26 level, but a big spike in the VIX normally corresponds with a big drop in the indexes. So we are always aware of this, of how one zigs when the other one zags. UUP, the dollar, down on the day, didn't really impact stocks. Tight range, also still in oversold territory. How about interest rates? The 10-year continues to fall, making new lows. Money flowing into bonds very clearly. Now, is that a fear trade? Probably. When you sync that up with the falling indexes, it kind of makes sense. How about the 30-year? I mean, look at how many gains. This is giving back all the gains going back to September, after it went on this really strong run up, now just basically same slope down that it took higher coming into the 200-day moving average. Let's take a look at gold. Dollar down, you'd expect gold to have a good day, and it did. Still below the 200-day moving average, though. Let's look at gold stocks, GDX. Still right at this 200-day moving average, riding this choppy EMA higher, firmly above the 21. So definitely in an uptrend, but can't get above that 200-day moving average. Notice it couldn't either back here in June when it tried to get above. When it rallied off the bottom. This rallied quite a bit stronger as we've gone from 22.58 up near 30. How about Bitcoin, BITO? Let's look at a 60-minute chart on there. It just continues really trading tightly. So it looks like all the sellers have done what they want to do, but no buyers are coming back in. So just hanging around that 16,000 area. Let's look at BND, the broad bond index, and this continues to trend higher. Getting into bonds for capital gains isn't something that you normally do, but it is a consideration now with this riding the ADMA higher. And let's look at junk bonds in case there's any fear in the credit markets. There's not. They're holding on to their 21 while the S&P has broken the 21. So interesting there how the junk, you can look at JNK or HYG. They're basically the same index, but same situation, holding on to the uptrending 21-day moving average there. Let's see what else we want to take a look at. Let's go to the tail of the tape, and then we'll go to the focus list. So fading bear market rally, put call spiked intraday today. Don't really know what's going on there. It's been a lot of people saying it's been acting very strange, and I would tend to agree. VIX right at the 21 EMA now for a while, trending below her. We got to pay attention to that. Fear and greed at 58. We're the bull case fading, the bear case coming into play. I would expect that CPI and the FOMC next week will have something big to do with that. Certainly volatility either way. How it shakes out, we don't necessarily know. A little bit of good news before the bell. NFP labor costs fell. That spiked futures, or actually brought them off their lows. And then during the day today, Goodluck, a very respected bond manager, Jeff Goodluck, said he doubts that the Fed funds rate can actually reach the terminal 5% rate because there's too much weakness in the economy. So first time I've heard somebody that you actually should pay attention to what they say. Doubt that we would get to 5% next year. So I thought that was interesting. Wanted to include it in the news. So day count, 2 days down, 1 day consolidation, but actually 5 days down off the high for the 5 major indexes. The 21 EMA has rolled over and 2 closes below. I talked about being neutral as long as we're above 3,900 on the S&P, but below the 21. That consolidation is intact. Same situation with the levels on the S&P and the NASDAQ 100. Volatile opening, as I said, then a type chop the rest of the day. Sectors, bond prices up, which means bond yields down. Gold, silver, and gold and silver stocks strong. Builder strong after tolls, TOL ticker. Earnings reaction, we'll take a look at that chart. XLV, healthcare strong, biotech strong. Dollar down, oil's down, semiconductors, tech down, software down, and jets, which had been holding up, gave up a good bit today, down 3.3%. So there you see the focus list. What we did was trim. So here's the S&P 500. We rallied into the 21 today. You see that high near around 39.57. My thought was to trim some of that when you came into 39.57, and you've got a high, so you've got resistance there, and you've got a high on the stochastic. The next thing, when you get into oversold and stochastic on the 5-minute, you usually get 2 to 3 tests on the highs and the lows each day. Sold some of that into it. when we started to come off there, like, and broke down below 39.50. So we trimmed some of that, kept our hedges on. So as I said, we're about 90% hedged on the remaining long that we have. Don't want to sell out because the hedges are working. They're offsetting. We're basically holding steady on the indexes, and then we'll see how our individual holdings continue to last. And Celsius was down 6% at one point today, started to rally back up to the ADMA and hung there for a while, but that got us to the 2R, in other words, 2 times our risk. That's just a trading. You want to, if you're risking 1R and you can take 2R and bat 500 in the market, you're going to make money. And you have to, the way this market has been, we've been saying this for a while, you got to not give back your gains, even though you're taking them possibly prematurely on what would be a normal chart, but normal charts don't act the way in bull markets the way they do in bear markets. Right now, I'd be salivating at this, waiting for it to break out. That's not what's going on in this bear market, though. So we cashed our plus 2R gain, about 15% on Celsius after it bounced off of the lows today. So let's go back to the tail of the tape. That took our adjusted beta from 0.6 down to 0.44. Those two sells. Bottom line today, tight range, less than 1% chop between 3,900 support and 21-day exponential moving average / 3950 resistance. You can see the break yesterday of those two key areas. We undercut this basically the 100 and the 150 are flat and within a couple points of each other, and we undercut and reclaimed them yesterday and today. And then below there is the 3887 to 3907, let's just call it 3900 area, which is the next level down to watch. And then you got to go all the way further down to 3830 for the 50-day moving average. So those are the support levels coming in on the S&P 500. Critical that we hold them. Wouldn't be surprised if we hang out in this area till CPI on Tuesday and the Fed on Wednesday, just chopping around between different points. I don't know. I mean, there could certainly always be news that comes out that impacts the markets, but I'm not aware of any big economic data that would move it substantially. So that's where we stand. Let's get to the focus list now, and we'll start out with what we own still in-house. Boeing, 2 weekdays, but on much lower volume than the 2 days up and holding the 21-day moving average. Netflix outperformed today. Undercut and closed basically right on 1% above the ADMA. Steel Dynamics, strong early, gave it up a little bit in the afternoon, still trending above the ADMA. If this breaks the 8, we've got a half-size position in that. We'll probably lock in our 2R on half of that and let the rest of it ride. PI Impinge, still below the 2 closes below the 21 now. Tight range today, very similar to the markets. Holding on to a very small profit with this. Unfortunate. This is what I talk about, giving back profits. This thing has pulled back 10% over the last 5 days. In hindsight, hey, why not take gains? But on Friday, the market was looking a whole hell of a lot better than it is right now. Mobileye reported earnings. They were well received. It was up as much as 10% at one point, closed up 5%. So staying above, or at least closing above the ADMA for 5 straight sessions now. You can see the green line, the 21-day exponential moving average, trending higher too. Soon it'll be above that breakout level, which will provide an additional level of support. The SARC inverse ARC ETF continuing to treat us well, up a little bit today, offsetting losses in SPXL for sure, and same thing with FAS. This is basically 2 closes above the 21, but really you want to look at the underlying, which should show 2 closes below the 21, and it does. And again, the weakness in XLF, it's more pronounced in the banks. If you look at KBE, and you look at KRE, there's other financial type. I'm not aware of a direct inverse bank only ETF, but this FAS is really the big one, and it moves in sync with the inverse of the XLF, as I mentioned, and that has banks, but also a bunch of other financials in there, like insurance companies and so forth. So they're holding it up, but the overall trend down, and when the banks are down, FAS is going to work. So that's everything that we own right now in-house. Let's go to Apple. This is not helping the indexes. 2 closes below the 50, 21 rolled over. This 140 area is very key. Tesla even worse than Apple. 3 days down now, back below the 21 after 2 closes above. Hasn't made recent lows yet, but tough day this week for it. And then let's take a look at some stocks that are either reported earnings are holding up or are on our fundamental list waiting for the technicals, or had a big pullback and possibly offering a buy point. Now, I was looking at AEHR after these 2 big moves down, and AEHR is 8+% ATR. Was down 12% yesterday. I was actually hoping that it came down and bounced at the 50. I was considering taking a small long there, but it didn't get there. Instead, it bounced back higher, 6.71% today, closed just below the 21-day exponential moving average. Very clear it's a leader and the market is holding it back. ASO, sporting goods, great earnings announced, 18% short interest in this, according to MarketSmith. I actually read that it's over 30 and some other publications, but this goes on the gap list for monitoring. Didn't buy it because of the market state. ASO, 2 stocks that are holding up well in the medical products area, both insulin related. PODD bounced at the 21, consolidating nicely, and Dexcom, DXCM, same situation, consolidating nicely above the 21. Good fundamentals on both of those. Home Depot, Toll Brothers reported earnings today. We're going to look at that momentarily, but Home Depot holding up extremely well during this, and I did during this period, and I did talk about the theory that people can't buy new homes, but they can't buy new homes because if they sold theirs and had to get a new mortgage, their payment is going to go through the roof. So there's a thesis out there that stores like Home Depot will do well as people will put money into their existing home, and prices supporting that so far. Lowe's, not as much, relatively weaker and certainly more volatile to the downside. Tractor Supply, could argue that they do some of that too, not as strong. And BLDR, also more volatile, but maybe a little more upside, although with a PE of 3, which is frankly amazing, but 63% drop in earnings forecast for next year. So let's go back to the first one I talked about, Home Depot, well below their historical PE, continuing to grow their earnings, trading at 320. So last time, Home Depot's earnings are continuing to grow, and positive reaction to its last earnings report, also showing relative strength. So in that same vein, I said Toll Brothers reported good earnings today, up 7.75% on 180% above average volume. It's been consolidating around its 200-day moving average, poked above it. 50 is a huge level here. You can see 50 resistance here, 50-ish here, 51 here, 50 here. Let me put my alert back on for Toll, and let's move it up to 50. 50 is just that half Livermore level, and very often works as support or resistance. But let's look at the leader in the group, DR Horton, DHI, looking even better. Gapped up on its earnings, actually holding up and gathering relative strength. Higher high for the relative strength versus when it reported its earnings. So my 2 favorites in the group, DR Horton and Home Depot, and Toll certainly goosed that group a little bit today. And then I talked about ELF and how this stock has grown up basically before our eyes. It was too thin to buy back here, but now it's definitely maturing both in price and in volume. Going sideways here, but not while it's consolidating, it's still not giving up any relative strength. I see the stochastic has rolled over, but this is going to be on the 21 over 21 list by the end of the week unless it just gives it up by the end of the week. But half the stocks have broken their 21 today, or this week from last week's 21 over 21 list. So that's it. That's the focus list. Lots to chew on there, and that's going to wrap it. As always, remember, it's not how much you make in the market, it's how much you keep. We protect in the downside, participate in the upside. I'd like to get a little bit more upside to participate in, frankly, but my expectations have done about a 180 since last Friday. Somebody commented that I sounded scared on the last night's video. I battle fear and greed every day. That's just part of being human. But the process and the accountability in that process that we put out there every day is designed to filter the emotions out. So, yeah, maybe I might have sounded scared. I'm certainly disappointed in the action from a bull standpoint of what's transpired this week. I'm certainly aware of the macro, but was my expectations changed to positive Thursday and Friday, back to negative after Monday and Tuesday's action. And yeah, fear and greed are there, but the process filters them, and we discuss this process every night. I shouldn't, if I ever do anything when I'm going over these outside of the process that we've defined, let me know. And if I do, there's going to be a reason for it. And if there's something that's unexpected, that's why we put our contact info every day. So reach out, email don@revereasset.com. Or Dan, if you want to talk about coming on board, he'll answer all of your questions and get the process rolling. It's just a couple of signatures on a DocuSign. Or you can phone 855 Real Wealth. That's 855-732-5932. So, telling it like it is, this is Don Vandenbord wrapping up for Wednesday, December 7th. Yeah, I always have to think a day which lives in infamy. I can't imagine being at Pearl Harbor back in 1941. God bless everybody in the military. And thanks for listening, and have a great day.